Hey there. Every single day, the market is telling us a story about where business is headed. The thing is, it speaks two completely different languages, equity and debt. And by the end of this, you're going to be fluent in both.
So here's what we've got on tap. We're going to start at the very beginning, with a huge choice every single business has to make. Then, we'll dive deep into the world of equity, what it means to own a piece of a company. After that, we'll flip the script and explore the world of debt, breaking down exactly what a bond is and even meeting a few with some pretty interesting personalities.
So, I want you to picture this. A company has a brilliant, game-changing idea. Maybe it's a new factory or a new product, whatever, but they need cash to make it happen. This right here, this moment, it puts them at a massive crossroads, facing one of the biggest decisions they'll ever have to make. And that's where we hit this massive fork in the road. Does the company raise money by selling off pieces of itself or by borrowing it? That is the fundamental choice between equity and debt. Okay, so here's the bottom line. With equity, you become an owner. You're buying a slice of the pie. You share in the profits if things go well, but you also share in the risks. The sky's the limit, but you could also lose everything. With debt, you're just the lender. You're the bank. The company owes you money, and you get a fixed, promised interest payment. It's way safer for sure, but your potential reward is capped.
All right, let's head down that first path, equity. When you buy a share of stock, you're buying a tiny, tiny piece of a business. But that brings up the million-dollar question. How on earth do you figure out what that tiny piece is actually worth?
First up, we have face value. The easiest way to think about this is like the original sticker price. It's the official number stamped on the share when it's born, and it's mostly used for accounting. But it is important because often dividends are calculated based on this number, not the price it's selling for today.
Next is book value. This is the accountant's price. So imagine the company just stops, shuts its doors, sells off everything, the desks, the computers, the whole shebang. The book value is what the accountants say each share would be worth after all of that. It's the on-paper value.
And then we get to the one you probably hear about on the news every day, market value. This is the crowd's price. It's what people are actually paying for the share right now on the stock market. It's alive, it's breathing, and it changes with every bit of news, rumor, and economic feeling out there. And finally, we get to my favorite one, intrinsic value. Think of this as the detective's price. This is where you put on your Sherlock Holmes hat and ignore all the daily noise. You're not looking at today's stock price, you're looking at the business and asking, what is this thing really worth, based on all the money it's going to make from now until forever?
And who better to explain it than the man himself, Warren Buffett? He built his entire empire on this one idea. Figure out what a business is truly worth, and then just be patient enough to buy it when the market offers it to you on sale.
Okay, so that's the big question for any investor, right? Is the market price a good deal compared to what the company's really worth? Well, to figure that out, investors have this trusty toolkit of key financial ratios. Let's check out a couple of the big ones. Probably the most famous tool in that kit is the PE ratio, or price to earnings. It's asking a really simple question. For every single dollar the company makes in profit, how many dollars are investors willing to pay to own it? A PE of 20 means you're paying $20 for each dollar of earnings. Which, of course, leads to the big question. Is a high PE good or bad? Well, it depends. A high PE could mean a stock is way too expensive. Or it could mean investors are expecting explosive growth. It's the story of a hot tech company with a PE of 80 versus a stable old utility company with a PE of 15. The market is just betting on a different future for each one. All right, tool number 2 is the price-to-book ratio. Remember that accountant's value we talked about earlier? This ratio puts that number right up against the current market price. And here's the cool part. If the P4B is less than 1, it means you're technically buying the company for less than its assets are worth on paper.
Okay, deep breath. We're going to hit rewind, go all the way back to that fork in the road, and this time we're taking the other path. We are leaving the world of ownership and stepping into the world of lending. Welcome to the anatomy of a bond.
So, a bond is really just a fancy IOU. It's a formal loan, and it's got 3 simple parts. You've got the principal, that's the loan amount. You've got the coupon, that's the interest they pay you. And you've got the maturity, that's the day you get all your money back.
That's it.
Now listen up, because this next part is the golden rule of bonds. You have to get this. Imagine you buy a bond that pays you 3% interest. Life is good. But then, tomorrow, new bonds start getting sold that pay 5%. Suddenly, your little 3% bond looks, well,
Kind of lame, right? No one's going to want it unless its price drops to make it a better deal. It's a seesaw.
So how do we actually measure how sensitive a bond is to these changes? There's a word for it: duration. And a great way to think about it is like a lever. A bond with a high duration is like a really long lever. The tiniest nudge in interest rates sends the bond's price flying. A low duration, that's a short, stubby lever, much more stable.
So what makes that lever longer and therefore riskier? Two main things. First, the longer you have to wait to get your principal back, that maturity date, the riskier it is. And second, the smaller the interest payments along the way, the coupon rate, the more sensitive the bond is to any changes.
Okay, but not all bonds are created equal. They're not all these plain, boring IOUs. Some of them have, well, they have different personalities, different little quirks that make them interesting.
Take the zero coupon bond, for example. A normal bond might send you a little interest check every 6 months. But a zero? Nope. It pays you nothing until the very end. The whole game is buying it at a big discount today, say for $700, knowing that in 10 years it'll mature and pay you the full $1,000.
And then you get these really cool hybrids that totally blur the lines, like convertible bonds. They start out life as a normal, safe loan, but they have this secret superpower. The investor has the option to flip a switch and convert that debt into shares of the company's stock. It's kind of like having your cake and eating it too. You get the safety of a bond with the potential upside of a stock. So when you boil it all down, that's what it is. Equity and debt are the two distinct languages of the market. Equity is the language of ownership, of risk, of dreaming about massive growth. And debt is the language of lending, of safety, and of the promise of a steady income.
Look, understanding how these two languages work is absolutely crucial to understanding how finance works. They tell the story of a company's future. So the next time you look at the market, you can ask yourself a much better question. What story is it telling me today?